In 8 days, 5 of the largest companies on Earth reported earnings. Between them, they plan to spend more than $700 billion this year building artificial intelligence. The market paid 2 of them and punished 3. And it had almost nothing to do with how much they spent. So here's our base case. The market has stopped asking how much these companies are spending on AI and started asking who is paying for it. Cash from the business or borrowed money. What flips that read is an accounting change almost nobody read. Quick ground rule. Nothing here is advice. We map what's happening and how it breaks.
Start with the winners.
They look nothing like you'd expect. Microsoft had its best day since 2008, up more than 15%. Its cloud business, Azure, grew 43%, and the company guided to roughly 45% for the quarter ahead. Then Amazon. Amazon did the thing that was supposed to be fatal. It raised its spending budget from about $200 billion to $220 billion. The stock had its best day in more than a decade, up 15%, closing out a 2-day move of nearly 20%. Its cloud arm grew nearly 37%, the 5th straight quarter it accelerated, and its fastest in 18 quarters. Jassie's explanation wasn't defensive. It was a complaint about scarcity. Both companies also pointed at the same thing. Work customers have already signed contracts for. Microsoft's stood at $678 billion. Amazon's, $496.
Now the losers, where the obvious explanation falls apart.
Because Alphabet, Google's parent, has a bigger backlog than Amazon. $514 billion of contracted cloud work, roughly 5 times what that business earns in a year. Google Cloud grew 82%, and the stock fell 7%. So it isn't demand. All of them can prove the demand. The difference shows up one line further down, in the cash. Alphabet's free cash flow went negative for the first time since Google went public in 2004, minus $5.9 billion. It filled the gap by borrowing. Long-term debt more than doubled in 6 months, from $46 billion to $98 billion. Meta was worse. Its free cash flow didn't just fall, it nearly vanished. $784 million, down 91%. And unlike the other 3, Meta has no contracted backlog at all. Nobody is signing checks for Meta's compute. It's building for its own products. On the call, its finance chief told investors Meta would keep adding compute in 2028 and beyond. Meta fell 8%.
So why did this suddenly start mattering in the last week of July?
The day before Microsoft and Meta reported, the Federal Reserve met and held rates. But 3 of its own officials dissented. Not for a cut, for a hike. The first time since 2016 that 3 of them pushed for the same rate move at once. The 30-year Treasury yield closed at 5.21%, the highest since 2007. That's the whole story in one line. When money was nearly free, $100 billion of spending was an option. At 5%, it's a bill. Which is why the market split 5 almost identical spending programs into 2 piles. Microsoft and Amazon are paying out of a cash engine growing faster than the bill. Amazon's operating cash flow rose 33% to $161 billion. Microsoft still threw off $19.6 billion of free cash, while spending roughly $41 billion in a single quarter. Alphabet and Meta are paying for it out of the bond market and their shareholders' patience.
So the base case is not that the AI build-out is ending. Nobody here is retreating. The base case is that the same dollar of spending now gets priced 2 different ways depending on where it came from. And while long yields stay here, that gap widens rather than closes. The cleanest evidence is the company we haven't mentioned. In the first 9 months of its financial year, Apple spent under $7 billion on property and equipment, less than the year before, while the other four raced past $700 billion between them. Apple fell this week too, but not for anything to do with AI. It fell on soft guidance, a miss in its services business, and China. Which is the tell? The market is not punishing AI spending. It's pricing balance sheets.
Now, be fair, because this reading has three real ways to break. First, the accounting. Microsoft is extending the assumed useful life of its data centers and office buildings from 15 years to 25, starting this fiscal year. That does two convenient things at once. It lowers future depreciation, which raises reported earnings. And it pushes leases out of the capital spending line, which is the only reason Microsoft's stated calendar 2026 budget fell from about $190 billion to $175, without a single dollar of spending being cut. Now, steelman it. 25 years for a building is not outrageous. Alphabet, one of the companies that got punished, already depreciates its own data center and office buildings over as much as 40 years. Microsoft isn't cheating. The problem is subtler. These five companies are not measuring the same thing. On equipment, Amazon went the other way entirely. Last year, it shortened the life of a subset of its servers to 5 years, saying plainly that AI was making them obsolete faster.
Second, the earnings themselves. Alphabet reported $9.11 of earnings per share. About $6.26 of that was gains on stakes it holds in other companies, Alphabet's own disclosure in its own filing, not an analyst's adjustment. Strip it out, and you get $2.85, slightly below what analysts expected. Amazon's headline has the same shape, a $53 billion gain, largely from its stake in the AI lab Anthropic. Two of these five had their headline profits flattered by marking up bets on the very boom they're funding. Third, the demand may simply be real. If Jassy is right that $220 billion still isn't enough, today's cash flow hole is a timing problem, not a solvency one, and the companies marked down for borrowing will look brave in 3 years. That's the bull case, and it isn't a stupid one.
Three things would tell you which way this resolves. 1. Free cash flow, not capital spending. That's the line the market is actually trading now. Watch whether Alphabet's stays underwater next quarter, and whether Meta's goes below zero. 2. New borrowing. Alphabet's long-term debt doubled in 6 months. If Amazon or Meta start issuing at anything like that pace, the market gets a second and third candidate for the same discount. 3. Depreciation schedules in the quarterly filings. If more of these companies extend useful life the way Microsoft just did, reported earnings across the whole sector get a tailwind that has nothing to do with a single extra customer. That's the one that would suggest the cycle is getting late. Nobody here is retreating. The build-out is happening, and it is enormous. What changed in 8 days is that the market stopped asking what these companies are building and started asking how they're paying for it. That isn't a bubble bursting. That's an invoice arriving. None of that is advice. It's a base case and the things that would break it. Subscribe for a clear-eyed read on what's actually moving markets every week. Last week, we mapped the box the Federal Reserve is trapped in, the same box that just repriced $700 billion of AI spending. That one's next on screen.